Hey guys, this is Mr. Oxy coming at you from West Palm Beach in Florida. It is Wednesday. It is August the 4th. The second quarter for Occidental Petroleum is in the books. And what I did was I took a deep dive into the earnings call that was earlier today, as I said, on Wednesday. And took down some notes, captured some of the content from the transcript, and I thought I'll put together a presentation to share some of the highlights reel with you. Now, usually when I do an Occidental earnings call video, I say the highlights or the lowlights, depending on who you ask. In this particular instance, it's pretty much just highlights. So it's all good. Believe it or not, it is whatever time it is right now. I think it's about almost 9 p.m. Eastern Standard Time. And the call was there for several hours ago, and the market closed already 5 hours ago. And as I speak to you right now, I haven't even had a chance to look at the price that Occidental closed at today. But we had a little mini market crash again today, and obviously energy pulled back as well. So I wouldn't be surprised if Oxy is cruising around $24, $25 a share. It doesn't matter in the greater scheme of things. What matters is your ability to be patient and to potentially ride the storm and get through to the other side. So a couple of highlights quickly. I shared some of these yesterday as well, and by now you've probably seen them already. $2 billion in free cash flow for the quarter is phenomenal. 1.2 million barrels per day of oil equivalent is phenomenal. In fact, it exceeded guidance. The $2 billion free cash flow topped expectations for most people. The $1.2 million barrels of oil equivalent per day was also exceeding their guidance. And then, of course, good news was the $3.1 billion debt tender offer, which had been completed recently, which retires some selected 2022 to 2026 debt maturities. Now, let's go into the notes here. And what I'm going to do is I'm going to go as quickly as I can. So as you can see, I've already captured some of the notes, and I've highlighted some of them as well. If you need to, you can always pause the screen to read the entire comment section. But here we go. So this is Vicky. She says drilling permits on federal land are now in the process of moving forward again. So you remember just a few months ago when President Biden got elected, and prior to that, when he was running for election, he said there will be no more drilling on federal lands, no more permits will be allowed. Well, it's moving forward again with the approval of new permits. Vicky says we still plan to run an average of 11 rigs in the Permian this year and 2 in the Rockies. Rob talked about the cash flow priorities, capital discipline, free cash flow generation, and balance sheet improvement. That's a good news story too. I think that's exactly what we want to hear. I know some people are saying, when are you going to pay a dividend again? I'm not one of those. I want to see the balance sheet repaired before you pay a dividend, and it's got to be a sustainable dividend. Current to our medium-term cash flow priorities focus on the balance sheet improvement, Rob says, as I just mentioned. Other notable comments, Rob said the credit ratings, he talked about that. He said we need to reduce the debt into the mid $20 billion range. Currently, it's around $35 billion. So we need to get down into about the $25 billion range, which is another $10 billion down from where we are right now. He says we have less than $225 million of maturities due for the remainder of 2021. So you don't have to be a rocket scientist to know that with WTI trading where it currently is, even though it's pulled back, it's still in the $70 range per barrel. Oxy is literally printing money, as you can also tell from their free cash flow that they generated. We will generate this cash from organic free cash flow, at a clip of $2 billion a quarter. It's good money, and close our remaining divestitures. And obviously they have a couple of deals in the offing on that one. Creative accounting, guys who have watched my videos before will know I talk about creative accounting from time to time. I once told the story and said, one of my university professors said, if you want to hire an accountant, all you have to do is ask them what is 1 + 1. If they answer and say, what would you like it to be? Then that's the guy you hire. So creative accounting, it's debatable. Anyway, what is the difference between adjusted and reported results? Well, it's primarily due to a gain in asset sales and positive fair value adjustments. So these things are kind of a little bit of, a little bit vague as we look at it. This quarter, we classified all our derivative instruments with mark-to-market adjustments as items affecting the clearability. In the greater scheme of things, none of these things are material to the actual results. This is just accounting fudging, a little bit of number manipulation in order to make things look the way you'd like them to look, as opposed to how they might look if it had headline news. Reconciling our actual results to guidance. In other words, he's just talking here about some of the things that they did from an accounting point of view. Some more creative accounting. Half of the working capital change was due to the commodity price. We know that. The other is timing. So I mentioned this as an example before as well. Under the GAAP accounting rules, it's critical when you actually recognize the revenue. Do you do it at the point of sale, or do you do it as you receive the cash? So there are a number of things that come into play in that regard. And I frequently use the example of Boeing. If Boeing secures an order for 20 787 Dreamliner jets, do they book the sale today, or do they book the sales as they deliver the jets over the next 10 years or 20 years or whatever the case might be? Obviously, these things are impactful in terms of how you report your revenue. Anyway, Rob says we also made several payments that are typical in the first quarter, like property taxes, cash interest payments, employee benefit payments, and pension contributions. There are reasons why he's talking about the first quarter. I'm going to get back to that in the Q&A section, which I'm going to cover in just a second. And expenses accrued last year were already paid in the first quarter of this year. Those are timing issues. When you for instance, when you book the sale, do you book the sale when you actually create the invoice to the customer and now it's your accounts receivable, or do you book the sale when you get the cash? And those are differences as well between the accrual accounting system and the cash-based accounting system. And they're very, very different in terms of how you track and record your revenue. Anyway, so a little bit of creative accounting is to be expected with any major company. 2021 break even to the mid $30 range on a WTI basis before the preferred dividend. We've heard about this several times before. Mid $30 range is their break even. There are reasons why it's not specified. I'll get into that one in just a second. Full year production guidance of 1.14 million barrels of oil equivalent per day remains intact. Let's see how we go. They may exceed that as well. And obviously it also depends on the macro, right? What's the demand like? What is OPEC doing? All kinds of other stuff come into play. And as does our full year capital budget of $2.9 billion. So all those things are in place. Let's look at the break even quickly. Mid $30 range on WTI basis before the preferred dividend. Now we know the preferred dividend is $200 million per quarter. So you can kind of reverse calculate that if you want to. I'm okay with mid 30s. Why mid 30s? Why is it a range? Because they give a range because it's influenced by several factors, including cash flows, natural gas prices, realization for our products, divestiture timing, where chemicals and miscreants falls in respect of earnings guidance. I'll give you some more info on that as we go, so just stick with me here for a minute. Permits, this is Vicky. I'm quoting, she says, we'll be able to continue permitting on current leases. My concern is that there could be a moratorium, so a dead stop, saying no more drilling on federal land. That would be bad for our industry. It would be bad for the United States. Vicky says at one point, we were at over 13 million barrels per day of oil production in the United States, which gave us strength in world politics. We could supply our own oil and products domestically. We would not have to import very much at all at 13 million barrels per day because our refining capacity is somewhere near 17 million. With a moratorium on federal leases, that will really drive down our industry's ability to react. So I hope the guys who make the decisions don't just make stupid political decisions, but they actually make decisions that are positive for the economy as a whole. Vicky says we have 9.5 million acres to develop in the United States. If you want to see where those 9.5 million acres are or what they're comprised of, you can look at the earnings call slide deck. There's a little graphic on there. There's a picture there that'll show you exactly where the 9.5 million acres are. And of that, only 1.6 million is federal, and about half of that is offshore. So Occidental is actually in a pretty good position from that point of view. So when Vicky talks here about the industry, she's actually lobbying on behalf of the entire oil industry and not just for Occidental. Some questions came up about CO2. The low carbon strategy is very connected to CO2 Enhanced Oil Recovery. We have a footprint in the Permian of not only reservoirs, floor space, and resources, but we also have processing plants. We can get more than 70% with CO2 flooding. Vicky says in the unconventional, most companies get at most a 10 to 12% recovery of the hydrocarbons from the shale play. We can get potentially 75% additional recovery, maybe even double that. So in the space of CO2 Enhanced Oil Recovery, Occidental is a leader, and it will be very interesting to see where they go in this regard on a go-forward basis. So Q&A time with the analysts, all my favorite friends. Doug from BAML, so Bank of America Merrill Lynch, asked a question about tax break-even. He's talking here about Q1, and the reason why he's talking about Q1 is because you see the impact of taxes, obviously, in the next quarter or a few months down the line. So he said annualizes 6.4 billion, 215 million per dollar, million per dollar is $30, and the average WTI price in Q1 was 57.61. So in case you were wondering what the average price was for WTI, I actually thought it was about 60, maybe 61. It was actually 57.61. How do you get to the mid-30s? Doug asked. Rob answered, and he said, what's missing from your calculation is CapEx and chemicals and their performance throughout Q1. The midstream inclusion in Q1 is more of a one-time event associated with Winter Storm Uri. So I think it's part of annualizing the Q1 numbers. When you calculate an average price for Q1 for WTI 57.61, it's actually a tricky thing to do because it comes back to that concept of talking about when you actually realize the revenue, because sometimes the oil is like literally floating on the water because it's been shipped somewhere. So at what point was it delivered and at what price was it sold? So it's not always clear as mud when you're trying to figure out exactly what the break even is. And in Oxy's case, it's even more made more difficult or more complicated because of the various different business streams in terms of OxyChem, natural gas, WTI. You got to blend them all together and say, it's in a range of about the mid-30s or so. Divestitures, a little bit more progress this time, but still a long way to go to get to 2.2 or 3 billion, or 2 to 3 billion. Vicky said, I would say if I included unsolicited offers we have in hand, it would get us well above the $2 billion minimum target. But she also added, we always want to evaluate what it delivers for us versus what the cash flow in the future would generate. And this is a very important point, right? It's very easy to say, let's sell something and we generate $700 million like they did recently when they sold the Colombian assets. And then firstly, you have potential write-down because it might have been on your books for 850 million. You sold it for 700 million, so you write down 150 million, and you got $700 million cash in hand in order to service some of your debt obligations and interest. The problem is, if you don't do good due diligence in that regard, you might be selling an asset for $700,000 that could generate phenomenal cash flow in the future. So it's not an easy discussion or decision to make when you talk about the sort of global or macro environment of M&A, mergers and acquisitions, right? It's sometimes much easier said than done. The working capital draw. So Neil from Goldman Sachs said, why was the working capital number so large? Rob said, we historically see a somewhat significant draw in Q1. Now, again, we're looking back here at Q1, and that's where the questions came from, because they weren't looking at Q2 so much. They were looking at changes that had occurred since the Q1 reporting was in the books, and then what happened after that during Q2. Rob added that regardless, the 1.33 billion draw we experienced in Q1 is exceptionally large. The majority of that was driven by the change in the commodity prices. It was the timing difference between the revenue recognition and cash received. So I just covered that a couple of times now, right? It's like, when do you recognize the revenue and when do you receive the cash? So these things are not necessarily the same. At the end of 2020, WTI was about $48 a barrel, and it was about $61 a barrel at the end of March. This price increase of 30% impacts both our accounts receivable balances and our inventory significantly, especially when you consider our midstream business and how many barrels are on the water at any given point in time. Tough, huh? It's not so easy running a multi-billion-dollar company. Janine from Barclays asked the question about getting the long-term debt down into the mid-$20 billion range. About another $10 billion to go. Prior target of 3 times leverage as a trigger for growth. Rob said that break-even location, is it exactly 20 something? In other words, do we need to go down to 10 billion? It's not a clear-cut decision. In other words, we're not saying we need to go from 35 to 25 in order to hit investment grade status at mid-cycle prices. It's not an absolute number. It's guidance. Basically, Occidental is saying we'd like to get the long-term debt down by about 10 billion, sort of in the mid $20 billion range. Rob added that it could mitigate to be a little higher, and that would be possible to get investment grade status, even if the debt was a little higher or even a little bit lower than that. So in other words, it's sort of a target number that they've thrown out there saying this is where we will need to be in order to achieve investment grade status. The dividend, so many people have asked questions about the dividend. Rob said, this might have been Vicky, we've focused on the leverage reduction right now and using the proceeds both from our free cash flow and from our divestitures in order to reduce that leverage, right? So if that's the primary focus, and as an investor in Oxy, I am happy with that. That conversion will eventually rotate over into a medium-term priority. Medium-term for most people means about 3 to 5 years, but we're already sort of a year or so into it, so it's kind of like another 2 years away or so, I'd say, before you see a sustainable dividend. All things remaining equal, obviously we need WTI to remain at a price that's reasonable, you know, sort of at least in the 60s or so, in order to make the dividend sustainable, methinks. But you can let me know what you think in the comments. We haven't yet established a policy on what a dividend might look like, but it's going to have to be sustainable, and it could be a combination of something that's fixed and some variable component. Well, it's an interesting one because we hadn't had any discussion in that regard before. So we've talked about the dividend and when the dividend might be reinstated or when the shareholders would be rewarded for their patience, but we didn't really talk about what it might look like. Now, of course, last year they did some warrants, and going forward they could do something like that again, or something different, or something that's a combination of the two. In this case, he's talking about a dividend that could be a combination of something that's fixed with some kind of a variable component. Devin from Morgan Stanley asked about the run on the cost structure here, and Vicky replied and she said, we rolled out Oxy Drilling Dynamics, and we haven't seen an area where we haven't rolled this out. And the question here sort of relates to Anadarko, as like, have you squeezed everything out of it that you could, or is there more room to reduce the cost structure here? So Vicky's reply says, we haven't seen an area where we've rolled this out where we haven't had about a 20 to 30% reduction in cost. We've decreased our drilling cost from $200 a foot back in 2015 to $135 a foot in 2021. That's a 6-year gap. And if you think of how the costs of almost everything have increased in the past 5-6 years or so, to get your drilling costs down from $200 a foot to $135 a foot over a period of 5 to 6 years is phenomenal. Good management, good job, well done, Occidental. I'm going to kind of wrap it up with this slide here, and we know that the current focus is on maintaining production and on debt reduction. And there's your medium-term thing, right? Sustainable dividend and some growth capital. And then longer term, there right at the bottom, it says retire the preferred equity. And obviously the focus there is squarely on our favorite Uncle Warren Buffett's preferred shares valued at about $10 billion, which pays a coupon of 8%, which is $200 million a quarter. That's kind of like way in the distant future, right? So right now we are going to fix the balance sheet, and once we've repaired the balance sheet and fixed the long-term debt and effectively just eliminate this wall of debt, which Oxy is in a very good position to do right now. After that, medium term, we can take a look at implementing a sustainable dividend, which, as Rob said, might be a combination of some sort. So, guys, that's where we're at. That's sort of a quick wrap on the earnings call today from Occidental Petroleum Q2 2021. And on that note, this is Rudy signing off, saying thanks for watching, and I'll see you guys soon. Let me know in the comments what you think. Bye-bye.